Let's now take a look at opportunities beyond the Australian market, specifically Japan. We are joined by Jamie Halse from Sengen Capital. Jamie, welcome.
Nice to be here, Andrew.
So, Japan, why are you focused there? What opportunities do you see?
Japan's been this market that was out of favour for such a long time, and one of the reasons is the management teams in Japan never had to care about shareholders. The government has been pushing this corporate governance reform there for the last decade plus, so now we've reached a point where management teams have started to have to care more about shareholders, but we're still seeing a lot of valuations, particularly amongst the small caps, that reflect a management that hasn't yet changed their approach, where there's an opportunity for shareholders to go in, make their views known, and actually push management to change what they're doing and actually realise some of the value that's trapped on these balance sheets. And I'm talking big real estate portfolios, tons of cash sitting on the balance sheet.
How are you identifying those opportunities, particularly among those small caps? I would imagine there's many to choose from.
There's a fair bit of IP behind it. I don't want to bore your listeners with going through the drudgery, but we're looking for hidden assets that aren't easy to see. So, for example, the first company that we invested in has a factory sitting on residential property in central Tokyo, surrounded by apartment buildings. That's the kind of example of the hidden assets that you can find on these balance sheets in Japan.
So are there any particular sectors you're focused on, or are you just looking for that value at the moment?
Just looking for the value. So we're sector agnostic. We've come across firms ranging from IT services through to basic manufacturing and construction. There's a range.
How would you, you mentioned obviously the history of the recent Japanese market there in terms of the equities, but you take a look over over the past 5 years has doubled.
It has.
What has driven that, and what are you seeing now? Clearly, there's a focus on the Bank of Japan. It's turned hawkish. Likely the interest rates are going to go up. And of course, Japan is also one of those economies very much affected by the energy crisis at the moment.
Yeah, so there's a bit to unpack in that question. So what's driven Japan really has been, since Warren Buffett visited in 2023, the market's cottoned on to this corporate governance reform story where you're seeing just increased share buybacks and dividend payouts, which have doubled over the same period. Foreign investors flooded into the market, and that drove the big caps up a lot. They were trading at a massive discount to the rest of the world. They've closed a lot of that discount, but still somewhat discounted. The small caps got left behind a little bit because it's much easier for big foreign investors to just go into the major indices. The next leg of that has been, as you say, the BOJ turning hawkish, and what that's meant for the banks. So the banks were earning tiny net interest margins because they couldn't really lend at a decent rate because of the BOJ's interest rate policy. As interest rates go up, they price off the BOJ's reference rate, but their deposits don't reprice anywhere near as quickly. There's a surplus of deposits in Japan. The Japanese are great savers. So the banks have been able to dramatically increase their profits as a result of the BOJ hiking. And that's driven the next leg up in markets, as well as the weak yen helping the profits of global and export-oriented businesses.
Do you see some particular headwinds there at the moment, though, with the
energy crisis? There's definitely a headwind for the consumer, but the government is responding with subsidising some of the fuel costs. It's not like Australia, though. Australia is so much worse off. Japan has 250 days plus of petroleum reserves. What do we got here? 3 weeks? So Japan has had a bit of foresight. They have their own refining capacity. They're in a much better position than Australia is.
And Jamie, how do you see historical and cultural factors influencing investment there, and also in particular demographics, because it has a rapidly ageing population?
Yes, and that's part of what's driven this corporate governance reform. The government needs to encourage productivity growth, to encourage real wage growth, because they need labour to become more productive to be able to support this ageing population. They need to encourage better investment returns to pay the pensions in the old age, as that old age cohort increases. And that's really been one of the major drivers behind all this. So what was the other part of the question?
Well, just in terms of the aging population.
So the historical factors. So
and historical and cultural factors that are playing into that.
Yeah. So historically in Japan, you had maybe 10 to a dozen companies that controlled 50% of the economy pre-World War II. The Americans came in and occupied the country after World War II, broke those conglomerates up and basically stripped the powerful families of their assets. Then you had a bit of corporate raider type activity, and all of these old business relationships, they started buying shares in each other with the promise that they'd always vote for each other. So we went from Zaibatsu to Keiretsu. And that continued through the 90s. And it's only in the last 20, 30 years that those cross shareholdings have started to come down, which means that outside shareholders actually become a voice at the table. Before that, it was just companies run by management, and for their customers who were their management friends.
Well, to that point then, I see you note that shareholder activism can actually turn those value traps into some significant investment returns.
Exactly. So we are focused on deep value shareholder activism in Japan. I wouldn't buy into a lot of these companies if I was just taking a deep value approach, because you need something to change. They're not valued unfairly if nothing changes, because shareholders will never see the capital on the balance sheet unless shareholders come in and actually take action to push change through. So we buy big positions in these companies, engage with the management teams, ask them to do things like implement increases dividend payouts, share buybacks, and actually look at their operations, restructure inefficient, underutilized factory footprints, sell off surplus land. These kinds of things that are actually shareholder-oriented reforms that the government is pushing them to do, and we're just adding our voice to that.